All right, so let's dive right in. Everyone's been talking about how crazy the stock market's been lately in 2025, and today we're going to break down this French financial analysis called Overvalued Actions, Risks and Sales Strategies in 2025. And basically, we're going to look at, how to handle a really volatile stock market.
Oh, yeah. Oh,
Like
yeah.
what's making it dip, what stocks are looking a little too pricey, and then what you might want to do about it.
Yeah. Makes sense.
So I think a good place to start is, last week, Wall Street had a pretty rough time. I mean, some are even calling it Black Week, and like the NASDAQ and the S&P 500 both saw, some pretty significant dips.
Right.
One company that really stuck out to me though was Nvidia. Their stock dropped by like 20%,
Oh, wow.
which is, a pretty big hit, I'm sure, for a lot of investors.
Yeah, that's a lot.
What do you think's going on there, particularly with those tech stocks? I mean, are they just extra vulnerable right now?
Yeah. I think it just shows how quickly, the market can turn, even for like a company that's been doing really well, like Nvidia. And, maybe there's worry that some of these tech stocks are just, overvalued at this point.
Right.
Or
Yeah.
maybe people are, taking their profits now after such, a good run.
Makes sense.
That explains, yeah, for sure.
And then we've got like these totally different predictions from Bank of America and Goldman Sachs, right?
Right.
Bank of America is saying we could see like a 40% correction, but then Goldman Sachs is saying, yeah, there are some stocks that are overvalued,
Yeah.
but they don't see it being, quite that bad.
Hmm.
I mean, how should we even be like thinking about these institutions, as individual investors?
Well, it's good to keep in mind that like both of them have their own ways of doing things, and their own like perspectives. Like
Yeah.
Bank of America, they tend to be more on the, you know, cautious side. So maybe they're kind of thinking about a worst case scenario with that 40%. And then Goldman Sachs, I mean, they're usually a little more optimistic. They tend to think more about long-term growth and potential. So,
Gotcha.
it's not really about picking which one is, right? It's more like trying to understand, the big picture and what could possibly happen.
Yeah. Yeah, I see what you mean.
Like what's important for individual investors is to realize that even if, the market overall is doing okay, you could still lose money if you pick the wrong stocks.
Yeah, for sure. For sure. Okay, so this kind of leads into my next question, which is about a company that seems like it should be doing great. I mean, at least on the surface.
Okay.
Altria, the tobacco giant,
Yeah.
their stock is up 39% this year, which sounds like amazing.
Wow.
But this analysis says it might be, overvalued.
Mm.
So what's the deal? Like, what are we not seeing here?
So the interesting thing here is, 39% sounds pretty good, but if you look at the S&P 500 over a longer period of time, Altria is actually doing worse.
Ah, okay.
And on top of that, its current price is way above its historical average.
And what does that even mean, like historical average for a stock?
So like imagine you're looking at a graph of, how Altria's stock has been doing for like the last 20 years or something?
Yep.
You'll see times when it goes up and down, but you can also see kind of a normal range where it usually stays.
Okay.
And if it's like way above that range right now, it could be a sign that people are getting a little too excited,
Yeah, like it's not going to stay that high.
Right, exactly. And in Altria's case, the analysts are actually predicting that it might drop by like 5% to about $55 a share.
Interesting. So it's like that old saying, what goes up must come down.
Kinda, yeah. I mean, it's more about, finding actual value, not just following what's trendy.
For sure. For sure. Okay, so let's look at another example. IBM.
Okay.
Their stock has also gone up this year by 33%. But again, this analysis is saying it might be overvalued.
Mm.
What are the red flags with IBM?
So IBM is not really keeping up with how much the market overall is growing.
Yeah.
And if you look at its valuation ratios, particularly its PE ratio, that's kind of a warning sign.
So can you like break down what that means, like the PE ratio?
Yeah, so the PE ratio basically tells you how much you're paying for each dollar of the company's earnings.
Okay.
So if a company has a really high PE ratio compared to like its history or its competitors, it could mean that it's overvalued.
Gotcha.
And in IBM's case, that high PE ratio, plus the fact that it's not growing as fast, it makes it a riskier investment.
Okay, so thinking about these examples, like are there any general signs we should be looking out for with, any company to see if it might be overvalued?
Oh, yeah, totally. So like those high PE ratios we talked about are definitely one thing.
Okay.
And then low dividend yields are another one.
Yeah.
So if the company's stock price is high, but the dividends are low, it could mean that the price is just inflated.
Right.
And then also look out for when a company's stock is going up, but their growth forecasts are actually weak. That's a sign that the market might be getting a little too optimistic. And, maybe people are just excited about hype, not, the company's actual potential.
Yeah, that makes sense. Okay. So it's not just like individual companies, right? I mean,
Yeah.
there are also those bigger economic things happening that could make this whole overvaluation thing even worse.
Exactly. Yeah. Things like tariffs and changes in interest rates, they can have a huge impact on the whole market.
Yeah.
Like, tariffs can mess up global trade and hurt companies' profits. And when interest rates go up, it gets more expensive for companies to borrow money, which could slow down growth.
Yeah. Yeah. Okay. So taking all of that into account, I mean, all this volatility, all these warning signs, and then these big economic factors,
Yeah.
what does it all mean for someone listening right now? Like, what should they actually do?
Yeah. So, first off, I'd say take a look at your own portfolio
Okay.
and see if you own any stocks that are showing those warning signs we talked about, like the high PE ratios, the low dividend yields.
Right.
And if you do own those stocks, ask yourself if you still believe in them. Is there a good reason to hold on to them?
Right.
Another thing to think about is rebalancing your portfolio.
Okay.
So that could mean diversifying and investing in some assets that tend to be more stable when the market is going down.
Right.
If you don't like taking big risks, that might mean investing in government bonds.
Okay.
If you're okay with a little more risk, you could look at real estate investment trusts.
Gotcha.
And if you're someone who really likes risk, then maybe you could try to find some undervalued assets in sectors that are likely to grow in the future.
Okay. Okay. Cool. Good advice. So I think we've covered a lot today. We talked about how volatile the market is, all those signs that a stock might be overvalued,
Yeah.
and then some things you can actually do about it. But before we go, I want to leave you with a question to think about. People are always saying that market corrections are going to happen eventually. So does that mean we should just like brace ourselves and wait it out? Or could it actually be a chance to buy up those undervalued assets, while everyone else is freaking out? What do you think?
Good question.
Thanks for joining us today on this deep dive.
Yeah, it was fun.
We'll catch you next time.
Sounds good.